I want to begin with a quiet, honest moment. There are times in any market when confidence gets tested, when even experienced observers pause and ask themselves difficult questions. Recently, the silver market has gone through one of those periods. Prices have moved sharply, sentiment has shifted, and many people are trying to understand what it all means without rushing to conclusions. After a period of strong gains, silver experienced a noticeable correction. Movements like this can feel intense, especially when they happen quickly. It is natural for investors and observers to question whether the broader trend has changed or whether this is part of a larger cycle that has been seen many times before in commodity markets. Instead of reacting emotionally, it is useful to step back and look carefully at the available data, not opinions, not headlines, but measurable information that helps provide context. When you do that, a more balanced picture begins to emerge. Over a longer time frame, silver has still shown significant strength compared to previous years. Even after a pullback, the price level remains considerably higher than it was not long ago. This does not guarantee future performance, but it does remind us that short-term movements do not always define long-term trends. One important way to evaluate any market is to ask a simple question. Have the underlying reasons for interest in that asset changed? If the answer is yes, then a reassessment may be reasonable. If the answer is no, then price movements alone may not tell the full story. Looking at publicly available data from major exchanges, one of the most discussed topics has been inventory levels. Over time, reported registered silver inventories have declined. This trend has been observed across multiple reporting periods and is often interpreted as a sign of tightening supply within exchange systems. At the same time, delivery activity has drawn attention. There have been periods where delivery volumes increased compared to prior years. This suggests that some market participants are choosing to take physical delivery rather than simply trading contracts. However, it is important to remember that delivery data can fluctuate and may be influenced by a variety of factors, including hedging strategies and seasonal demand. Another data point often discussed is market positioning. Reports that track how different groups of traders are positioned show that speculative activity can rise and fall over time. Periods of lower participation have historically occurred during both market bottoms and transitional phases, so interpretation requires caution. Commercial participants, including large financial institutions, also play a role in these reports. Their positions can appear large relative to available inventories, but these positions are typically part of broader risk management strategies rather than simple directional bets. Understanding this distinction is essential for avoiding misinterpretation. International markets provide another layer of perspective. Pricing differences between regions can occur due to local demand, currency factors, and logistical considerations. While these gaps may attract attention, they do not always indicate a permanent imbalance. Global demand for silver continues to be influenced by industrial uses. Applications in electronics, renewable energy technologies, and other sectors have contributed to steady consumption. At the same time, mining supply tends to grow gradually, often influenced by broader trends in base metal production. This balance between supply and demand is complex. Some analyses suggest that the market has experienced periods where demand exceeds newly mined supply. Others highlight recycling and existing above-ground stocks as important components that help meet demand. Both perspectives are part of the overall picture. It is also important to consider the role of the broader economic environment. Currency strength, interest rates, and geopolitical developments can all influence commodity prices. For example, during times of uncertainty, some investors may move toward assets they perceive as stable, while at other times they may favor income-generating investments. The strength of the US dollar is often mentioned in discussions about silver. A stronger dollar can create headwinds for commodities priced in dollars, while a weaker dollar can provide support. However, currency movements are influenced by many factors, including global economic conditions and monetary policy decisions. Geopolitical events can also have an impact, sometimes creating short-term volatility. Markets may react quickly to new information, but these reactions do not always lead to long-term trends. History shows that commodity markets often adjust as situations evolve. When considering any decision related to silver, it is helpful to distinguish between different types of exposure: physical ownership, exchange-traded products, futures contracts, and mining shares each have their own characteristics, risks, and advantages. They should not be treated as identical. Physical silver, for example, is a tangible asset. It does not depend on a financial intermediary in the same way that paper-based instruments do. However, it also does not generate income and may involve storage and security considerations. Paper-based exposure, on the other hand, offers liquidity and ease of trading, but comes with its own set of risks, including market volatility and, in some cases, counterparty exposure. Understanding these differences helps create a clearer framework for decision-making. Another useful perspective is to focus on time horizon. Short-term trading decisions are often influenced by price momentum and technical factors, while long-term positions are usually based on broader economic themes and structural trends. Risk tolerance is equally important. Some individuals are comfortable with volatility, while others prefer stability. There is no single correct approach that applies to everyone, and decisions should always align with personal financial goals and circumstances. It is also worth remembering that no single data point provides a complete answer. Markets are influenced by a combination of factors, and even well-supported analysis can change as new information becomes available. Responsible analysis avoids making guarantees or definitive predictions. Instead, it focuses on probabilities, scenarios, and the range of possible outcomes. This approach helps reduce the risk of overconfidence and encourages more thoughtful decision-making. There are also different viewpoints among analysts. Some see current conditions as supportive for higher prices over time, while others emphasize potential challenges, such as economic slowdowns or changes in industrial demand. Both perspectives contribute to a more balanced understanding. One key takeaway is that market behavior often reflects a mix of expectations, not certainty. Prices move based on what participants believe will happen, not just what is happening now. As expectations change, prices can adjust quickly. For anyone following the silver market, staying informed through reliable sources is essential. Public reports, exchange data, and official statistics provide valuable insights, but they should be interpreted carefully and in context. Emotional reactions, especially during periods of volatility, can lead to decisions that are not aligned with long-term objectives. Taking time to review the data and consider multiple perspectives can help maintain a more measured approach. Diversification is another principle often discussed in financial planning. Holding a mix of different assets can help manage risk, as different investments may respond differently to the same economic conditions. Ultimately, the question of whether to buy, hold, or sell silver does not have a universal answer. It depends on individual circumstances, including financial goals, investment horizon, and risk tolerance. What can be said with confidence is that the silver market remains dynamic and influenced by a wide range of factors. Supply trends, industrial demand, monetary policy, and global events all play a role in shaping its direction. Rather than focusing on short-term movements alone, it can be helpful to view the market through a broader lens. This includes understanding historical patterns, current conditions, and potential future developments without assuming certainty. Clear thinking, patience, and careful analysis are often more valuable than reacting quickly to headlines or sudden price changes. Markets reward discipline over time, even though short-term movements can feel unpredictable. In closing, the most important approach is to stay informed, think critically, and make decisions that are consistent with your own financial situation. There is no need to rush, and there is value in taking the time to understand the bigger picture before acting. This is not about telling anyone what they should do. It is about presenting information in a way that helps you make your own decision with clarity and confidence, based on facts rather than fear, and understanding rather than speculation.